Hey everyone, welcome back to Corporate Decoder. Today, Putnam Diversified Income Trust just filed its latest semi-annual shareholder report, and I am diving into the financial details to see what the numbers are saying. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report is packed with data on their investments over the past 6 months, but what really matters is digging into where the money is actually going and how that translates to performance for investors. First up, this filing gives us a look at the costs associated with holding shares in the trust. For example, with class of shares, the cost of a hypothetical $10,000 investment for the last 6 months were about $48, which works out to 0.96% of that investment. This might sound small, but over time these fees can really add up and impact your overall returns. It is important to remember though that these figures reflect fee waivers and expense reimbursements. Without these waivers, the costs would have been higher, meaning investors are getting a bit of a break right now. It is always worth checking if these waivers are temporary or permanent. Now let's talk big picture numbers. As of the 31st of March 2026, the total net assets for Putnam Diversified Income Trust were just shy of $920 million. That is a substantial amount of money being managed. The report also shows a total of 780 portfolio holdings, which means the trust is quite diversified across different investments. However, the portfolio turnover rate is listed at 2011%. A high turnover rate like this suggests the fund managers are actively buying and selling securities often within the same year. This can lead to higher transaction costs and potentially short-term capital gains, which are taxed at a higher rate. It indicates a very active management strategy, and it will be interesting to see if this strategy delivers strong returns. Diving into the actual investments, we see a significant portion of the portfolio is in corporate bonds, which make up about 32.6% of the total. Looking deeper within that category, convertible bonds are listed with a value of over $32 million. Convertible bonds are interesting because they can be converted into a set amount of the issuing company's stock. This gives them potential for both the income stream of a bond and the upside of stock ownership. The schedule breaks down these corporate bonds by industry, with aerospace and defense accounting for 1.3% of this category. Scrolling further, we see a substantial allocation to corporate bonds across various industries like banks, which represent 2.4% of this segment, and auto components at 0.1%. These are long-term investments and their value can fluctuate significantly with economic changes in company performance, which is why seeing the details within these categories, like the specific companies and their bond details, is crucial for understanding the risk and potential reward. The trust also holds significant amounts in senior floating rate interests, making up 5.1% of the portfolio. These are loans where the interest rate can change over time, often linked to a benchmark like SOFR, the Secured Overnight Financing Rate. This means that when interest rates rise, the income from these investments can also rise, which can be a positive in certain economic environments. The report lists billions in holdings within this category, showing a substantial commitment to these types of assets. A very large piece of the puzzle is mortgage-backed securities at 69.2% of the portfolio. This is a huge chunk and includes holdings in Federal National Mortgage Association, or FNMA fixed-rate securities valued at over $601 million, and Government National Mortgage Association, or GNMA fixed. Rate securities valued at over $35 million. Mortgage-backed securities represent investments in pools of mortgages, and their performance is closely tied to the housing market and interest rate movements. Given the current economic climate, it is crucial to understand the specific types of mortgages within these pools and their associated risks. Residential mortgage-backed securities make up another 7% of the portfolio. These are similar to commercial mortgage-backed securities but are backed by pools of residential mortgages. The details here show a lot of investments in trusts like A&D Mortgage Trust and Alternative Loan Trust. These types of investments can be complex and their performance is heavily influenced by homeowner behavior and housing market stability. We also see agency commercial mortgage-backed securities at 9.1%. These are backed by mortgages on commercial properties like office buildings and retail spaces. With the ongoing shifts in commercial real estate due to work from home trends and e-commerce, it is important to consider the underlying quality of these commercial properties. Shifting gears to short-term investments, which make up 18.1% of the portfolio, we see significant holdings in commercial papers, totaling over $52 million. Commercial paper is a short-term unsecured debt instrument typically issued by corporations to finance short-term needs. The report also shows us treasury bills valued at over $5.3 million, demonstrating a move towards more liquid and stable short-term assets. This short-term allocation provides some stability and liquidity to the fund. Cumulatively, the total investments for the fund are valued at over $1.5 billion, with a cost of over $1.54 billion. This means there is a net unrealized depreciation of about $57 million overall, a consequence of market fluctuations. This is where the active management comes into play to navigate these market conditions and try to generate returns. Now let's look at the derivatives. The trust has engaged in various derivative contracts to manage risk and potentially enhance returns. This includes interest rate swap contracts valued at over $448,000 in assets and over $1 million in liabilities. They also have credit default swap contracts with a net value of over $3.2 million. These instruments are complex and can be quite risky. The report details their use in areas like managing interest rate risk and credit risk, which are two of the biggest factors influencing income, generating investments. For instance, the interest rate swap contracts are quite substantial with notional amounts in the hundreds of millions of dollars. This shows a deliberate strategy to manage interest rate exposure. Seeing the gross amounts of assets and liabilities related to these derivatives is important. For example, their forward exchange contracts show total assets of over $17 million and liabilities of over $10 million. This indicates an active use of these tools to manage currency exposure. Looking at the statement of assets and liabilities as of the 31st of March 2026, the total assets are over $2 billion while total liabilities are just under $1.2 billion. This results in net assets of over $919 million. The share classes have varying amounts of net assets, with Class A holding the largest portion at over $462 million. This confirms that while the overall portfolio is large, different share classes have different investor bases and may have different fees attached. In terms of operations for the 6 months ending the 31st of March 2026, the trust generated over $20 million in net investment income. This is the core income generated from the fund's investments before accounting for gains or losses from market movements. However, when we look at realized and unrealized gains and losses, the picture becomes more complex. The trust experienced a net realized gain of about $4.8 million, but a significant net change in unrealized depreciation of over $12.5 million. This resulted in a net loss from operations of over $7.6 million for the period. So while the fund is generating income from its holdings, it is currently losing ground on market value fluctuations, showing the dynamic nature of investment management. The statement of changes in net assets shows a net decrease of over $107 million for the 6 months ending the 31st of March 2026. This is largely driven by capital share transactions where more money was redeemed than invested across the different share classes. The net result is a decrease in the fund's overall net assets from the beginning of the period. This pattern of outflows suggests investors may be pulling money from the fund, which is a key indicator to watch. Finally, let's look at the net asset value per S-share. For Class A shares, it stands at $4.98. For Class C, it is $4.82. Class M shares are valued at $4.8 and Class Y shares at $4.91. These numbers reflect the value of the underlying assets in each share class after all expenses and fees on a per share basis. The difference between these values and the maximum offering price highlights the impact of initial sales charges and potential deferred sales charges. My biggest concern here is the overall decrease in net assets driven by share redemptions, which could put pressure on the fund's ability to maintain its strategies or manage liquidity. The active trading and use of derivatives, along with the substantial mortgage. Backed securities holdings means this fund is complex, and its performance will likely be tied to interest rate environments and the broader credit markets. The sheer volume of mortgage-backed securities, especially residential and agency commercial ones, is a major factor influencing its risk profile and potential returns. What I'm actually looking for is a clearer picture of how these active strategies and complex instruments will perform in different market conditions going forward. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, make sure to smash that like button and subscribe for more insights. Click the link in the description for our Discord community.